This explainer video provides an overview of the most important aspects of the INPAG framework, outlined in the preface and sections 1 and 2. The preface and section 1 are written for a general audience. However, section 2 is primarily aimed at a more technical audience, such as standard setters, financial accountants, and auditors. We will cover the foundational framework for INPAG, including describing what NPOs are, and the purpose of concepts and pervasive principles. We will look at the objectives and characteristics of information in general-purpose financial reports, and the elements within financial statements. And finally, we will review the high-level requirements for presentation and disclosure. INPAG has been developed to improve the quality, transparency, and credibility of NPO financial reports. To support the provision of NPO financial information that is useful for decision-making and accountability, balancing the needs of preparers and users. And to address specific NPO issues, which will promote the comparability of NPO financial reports. INPAG achieves this by making use of existing international accounting standards, with appropriate changes for the NPO context. The main standard used by INPAG is the IFRS for SMEs accounting standard. This is a version of international financial reporting standards that provides simplified guidance for small and medium-sized entities. Where the IFRS for SMEs provides appropriate guidance for NPOs, it is used in INPAG without amendment. Where it does not, INPAG also uses full IFRS accounting standards, international public sector accounting standards, and jurisdictional level standards to provide financial reporting guidance that is NPO-specific. NPOs have societal accountability. This is because of the services and goods they provide, the way they are funded, and the benefits they often receive, such as tax concessions. Even if their purposes are centered on a small section of the public, they have an accountability to society as a whole. This is not generally true for many for-profit private sector entities. For example, small and medium-sized companies are often owned by a small group of people or an individual family, and do not have a broader accountability to others. However, some for-profit private sector entities do have a broader accountability. The IFRS accounting standards call this public accountability. Public accountability is different to societal accountability. To have public accountability, an entity's debt or equity instruments must be traded in a public market, or one of their primary businesses must be holding assets in a fiduciary capacity, for a broad group of outsiders. These entities are required to use full IFRS accounting standards, and not permitted to use the IFRS for SMEs accounting standard. INPAG is not designed to be used by entities that have public accountability, as it is based primarily on the IFRS for SMEs accounting standard. But, some NPOs that have public accountability may find INPAG useful. If a publicly accountable entity applies INPAG, it is required to disclose why the use of INPAG meets the needs of users of its general-purpose financial reports. Decisions on which NPOs use INPAG will be made by individual jurisdictions. To assist them in making their decisions, and to help in writing the guidance, we have developed a clear description of what an NPO is, for the purposes of INPAG. This descriptive approach is based on the broad characteristics of NPOs. For the purposes of INPAG, NPOs are entities that publish general-purpose financial reports for external users, and have all of the following broad characteristics. Their primary objective is providing a benefit to the public. They direct surpluses for the benefit of the public. And they are not government or public sector entities that should prepare reports under public sector financial reporting standards. It will often require judgment to decide whether the broad characteristics have been met. Where it is not clear, INPAG provides indicators that can further assist. These are: an absence of individuals with rights to financial returns from surpluses. A requirement that upon dissolution, the NPO transfer residual net assets to an entity with a similar purpose. Receiving or providing voluntary funding. And holding and using assets for the benefit of the public. Let's look at an example to demonstrate application of this approach. Imagine a sports club that has been established to promote physical activity and well-being among a community with limited financial resources and little access to other sporting facilities. It is a membership organization. To participate in the club's activities, individuals must be resident in the local area and pay an annual membership fee. The membership fee is set at a nominal rate to ensure that it is affordable, and the club receives the majority of its income from grants. It also has a small clubhouse that is open to the general public, where it sells food and drinks. These are available at a subsidized cost to members. Any profits or surplus from the clubhouse and other activities are used to maintain the club's sporting facilities and pay for the costs associated with coaching. If the club were to dissolve, any residual net assets would be distributed to another entity with similar objectives in the community. Although the benefits of the club's activities are restricted to members, it is reasonable to describe it as an NPO. Membership is focused on a community with limited financial resources, little access to other sporting facilities, and membership fees are nominal. Any private financial benefits received by members from the subsidized food and drink are incidental, and they do not have a right to ongoing financial returns. The club receives the majority of its income from voluntary funding, and the assets it controls are used to promote the physical activity and well-being of members to the benefit of the community. It is not a government or public sector entity. Let's now look at the purpose of concepts and pervasive principles. Both the IFRS standards and IPSAS standards are based on their own conceptual frameworks, which are similar in many ways. But conceptual frameworks take many years to develop. A set of concepts and pervasive principles, similar to those that exist in the IFRS for SMEs accounting standard, serve a similar function. INPAG has concepts and pervasive principles that are appropriate for NPOs, to help ensure that the guidance is conceptually consistent, and that similar transactions are treated in the same way. The concepts and pervasive principles will also assist NPOs in developing accounting policies, in the rare circumstance that no INPAG section applies to a particular transaction. They can also help stakeholders to understand and interpret INPAG. General-purpose financial reports provide users with financial statements and supporting information that is both financial and non-financial. Their objective is to provide information about the NPO that is useful to users, and can be used for accountability and decision-making. Some stakeholders have rights to request and access information tailored to their own needs, like donors with reporting requirements as part of a grant agreement. This tailored information is not a general-purpose financial report. General-purpose financial reports are not developed to respond to the information needs of any one individual, whether that individual has rights or not. Rather, general-purpose financial reports are for a range of users who do not have a right to tailored information, but require information about an NPO's finances, what has happened during a reporting period, and other supporting information. These users are often referred to as primary users. For NPOs, these primary users are members of society, who benefit from the services and goods provided by the NPO. Resource providers, and those fulfilling oversight functions on their behalf. It is useful to note that donors can also be primary users, for example when they are carrying out due diligence on an NPO as part of a new funding application. For users to get the information that they need, the information provided must have certain qualitative characteristics. These are the qualities of financial and non-financial information included in general-purpose financial reports that are most likely to be useful for users. INPAG distinguishes between fundamental qualitative characteristics and enhancing qualitative characteristics. The fundamental qualitative characteristics are relevance and faithful representation. Relevant financial and non-financial information is capable of making a difference to the decisions made by users, because it is pertinent to their interests and needs. For information to be relevant, it needs to be significant enough that it will matter when a user is looking at accountability or the decisions it wishes to make. As a result, relevance includes the concept of materiality. Information is material. If omitting, misstating or obscuring it could reasonably be expected to influence the decisions made by users. Materiality is specific to an individual NPO and can be based on the nature of the item, magnitude of the item, or both. Information should faithfully represent the substance of a fact or event. This involves maximizing the extent to which the information is neutral, i.e. free from bias, and free from error. These enhancing qualitative characteristics improve the usefulness of information that is relevant and faithfully represented. Comparability. Information is more useful if it can be compared with similar information about other NPOs, and with similar information about the same NPO for another period or date. Verifiability. If information can be verified, this helps assure users that it is a faithful representation. Timeliness. Information is useful if it is available to users in time to be capable of influencing their decisions. Understandability. This comes from classifying and presenting information clearly and concisely. Cost is a pervasive constraint on the information that can be provided in general-purpose financial reports. Costs are incurred by NPOs in providing the information, and by users as they read and interpret it. Those costs must be justified by the benefits of reporting. In addition to this general pervasive cost constraint, INPAG also includes a specific exemption for undue cost or effort that applies to some of its requirements. In limited circumstances, this permits an NPO to not comply with a requirement if the cost or effort of obtaining the information needed would substantially exceed the benefits to users of having the information. This is not a general exemption. INPAG provides guidance on factors to consider if an NPO wishes the use of the undue cost and effort exemption, where this is allowed. When constructing financial statements, transactions and economic events are classified to general groups. These groups are called elements. INPAG defines a number of elements relevant for NPO financial statements. The main elements in INPAG are assets, liabilities, income, and expenses. Equity is also defined as an element. For NPOs, it is not expected to be common, or to be of more than nominal value. However, since it is possible in some jurisdictions, and distinct from other elements, it is included and is described in the NPO context. Assets, liabilities, and equity are shown in the statement of financial position. Income and expenses are shown in the statement of income and expenses, if they contribute to surplus and deficit as required by that statement. Remaining income and expenses are shown in the statement of changes in net assets. There is an additional section that shows balances on funds, with and without restrictions. This section is called net assets, but net assets are not an element in their own right. This is because transactions are not posted directly to net assets, rather the balances arise from the accumulated effect of income and expenses. An asset is defined as a present economic resource, controlled by the NPO, as a result of past events. So, what is meant by an economic resource? It is a right that has the potential to produce economic benefits, or to provide services and goods in accordance with the NPO's objectives. Economic benefits are cash inflows or a reduction in cash outflows. An example of an economic resource with the potential to produce economic benefits would be the right to receive cash from another entity for delivering services in accordance with a contract. INPAG defines the concept of service potential as the capacity of a resource to provide services and goods that contribute to achieving the NPO's objectives. An example of an economic resource with the potential to produce service potential would be the right to use a vehicle to deliver humanitarian aid. This concept of service potential is important as it provides a basis for an NPO to hold assets to achieve its objectives, without necessarily generating net cash inflows. A liability is a present obligation of the NPO to transfer an economic resource as a result of a past event. For a liability to exist, all three of the following criteria must be satisfied. The NPO has an obligation. The NPO has a duty or responsibility to another party that it has no practical ability to avoid. This is often a legal obligation, but it could also be a constructive obligation that has arisen because of an NPO's past activities. The obligation is to transfer an economic resource. For example, an obligation on the NPO to pay cash for services, or to provide goods to another entity. The obligation exists as a result of past events. For example, the NPO has already received services from another party. INPAG defines net assets as the residual of recognized assets minus recognized liabilities. Net assets are not a financial statement element. For many NPOs, net assets will be managed through separate funds, made up by the accumulation of past surpluses and deficits. INPAG requires that these funds are separated into funds with restrictions and funds without restrictions. Funds with restrictions will exist when there are externally imposed funding or other legal arrangements placed on the NPO by a resource provider that restrict those resources to be expended, invested, or retained by the NPO for a specific purpose or activity. Funds without restrictions are those that are freely available to be used by an NPO for any of its purposes or activities. This includes funds internally designated for a specific purpose or activity. Equity will exist in the rare situations where a party external to the NPO has a financial interest in the net assets of the NPO. In the NPO context, equity is defined as future economic benefits or service potential that have been contributed to the NPO by parties external to the NPO, other than those which result in liabilities, which establish a financial interest in the net assets of the NPO. To meet the definition of equity, the holders of the equity must have an entitlement to distributions of future economic benefits or service potential from the NPO, including upon dissolution of the NPO. The holders of the equity must also be able to sell, exchange, transfer or redeem their equity interest. Governance rights that might come from a funding agreement do not establish a financial interest in the net assets of the NPO, and would not lead to the recognition of equity. Changes in equity will come from new contributions from holders of equity claims, such as the purchase of share capital, and distributions to holders of equity claims, such as the repurchase of share capital. Income and expenses are the elements of financial statements that relate to an NPO's financial activity in a reporting period. INPAG defines income as the increases in assets, or the decreases in liabilities, that result in increases in net assets other than those relating to contributions from holders of equity claims. Conversely, expenses are defined as decreases in assets, or increases in liabilities, that result in decreases in net assets other than those relating to distributions to holders of equity claims. Although income and expenses are defined in terms of changes in assets and liabilities, information about income and expenses is just as important as information about assets and liabilities. Recognition is the process of capturing an item that meets the definition of one of the elements for inclusion in the financial statements. INPAG sets out the circumstances when an item can be recognized in the financial statements. In some cases, it may be unclear whether an asset or liability exists. This is referred to as existence uncertainty. For an asset or liability to be recognized, it must also be measured, and this may require an estimate that is subject to measurement uncertainty. INPAG provides guidance on recognition and explanatory information about uncertainties associated with an asset or liability's existence or measurement. Recognition links the elements in the statement of financial position, statement of income and expenses, and statement of changes in net assets. In the statement of financial position, at the beginning of the reporting period, total assets minus total liabilities is equal to net assets. During the reporting period, there will be changes to those net assets. Recognized changes in net assets during the reporting period are made up of income and expenses that contribute to surplus or deficit that have been recognized in the statement of income and expenses, plus income and expenses that have been recognized directly in the statement of changes in net assets, because they do not contribute to the surplus or deficit, plus any new contributions from holders of equity claims, minus any distributions made to them. The statement of changes in net assets starts with the opening net assets. These are broken down into balances on funds with and without restrictions, as well as equity if it exists. The movements in the year will normally be caused by the surplus or deficit from the statement of income and expenses, additional items of income and expenses that are recognized directly in the statement of changes in net assets, and reclassifications or transfers between funds. Where equity exists, contributions and distributions will also be recognized in the statement of changes in net assets. INPAG also covers derecognition. This is the removal of all or part of a recognized asset or liability from an NPO's statement of financial position. Derecognition normally occurs when that item no longer meets the definition of an asset or of a liability. An asset will be derecognized when an NPO no longer controls it, such as when a vehicle it owns is sold. A liability will be derecognized when the NPO no longer has a present obligation, such as when it makes a payment for work that has been performed for it. Elements recognized in financial statements are quantified in monetary terms. To quantify each item requires the selection of a measurement basis. Different measurement bases may be appropriate for different assets, liabilities, income, and expenses. INPAG allows items to be measured using their historic cost or their current value. Measures that use historical cost take information from the original transaction price, or other event that means that an item has to be recognized. This could be the contract price for something that has been used by an NPO but not yet paid. Measures that use current value take information updated to reflect conditions at the measurement date. This can include fair value, which is the price that would be received to sell an asset, or paid to transfer a liability, in an orderly transaction between market participants at the measurement date. Value in use, which is the present value of the cash flows or service potential that an entity expects to derive from the use of an asset. Or current cost, the cost of an equivalent asset at the measurement date, or the consideration that would be received for an equivalent liability at the measurement date. INPAG sets out the requirements for the presentation and disclosure of information in general-purpose financial reports. An NPO communicates by presenting and disclosing this information. Effective communication makes the information more relevant and contributes to a faithful representation. It also enhances the understandability and comparability of information. The information needs of users should influence decisions on selection, location, and organization of information. In making decisions about presentation and disclosure, it is important to consider whether the benefits provided to users of financial reports by presenting or disclosing particular information are likely to justify the costs of providing and using the information. This explainer video has provided an overview of the most important aspects of INPAG, related to the framework and the concepts and pervasive principles that apply to NPO financial and non-financial reporting. It has highlighted how INPAG makes use of existing international accounting standards with appropriate changes for the NPO context, the purpose of concepts and pervasive principles within those standards, and how INPAG makes use of a descriptive approach to NPOs. It has examined the objective of general-purpose financial reports, along with the qualitative characteristics of useful information that are included in them. It has identified the elements from which financial statements are constructed, and the recognition and measurement principles that apply to them. This has included a demonstration of how the elements in the statement of financial position, statement of income and expenses, and statement of changes in net assets are linked. Finally, we have looked at how INPAG sets out the requirements for the presentation and disclosure of information in general-purpose financial reports. To respond, visit www.ifrfornpo.org/have your say. Download a template response document, and upload your completed response or comment letter. Responses must be in English. The deadline is the 31st of March 2023.